Ever wondered why some people seem to have the magical ability to make their money work for them? Well, it's not magic, it's personal finance. It's a topic that impacts us all, whether we're aware of it or not. It's about making informed decisions about our money, and it's an essential skill in today's world. In this video, we will equip you with the understanding and tools to build a strong financial foundation. The secret to this magic is having a strong financial foundation. So, what exactly is a financial foundation? Imagine building a house. You wouldn't start with the roof, would you? No, you'd begin with a solid foundation. The same principle applies to personal finance. A financial foundation is that solid base upon which you build your financial house. It's the groundwork for your economic stability and prosperity. It's the difference between living paycheck to paycheck and having a cushion for life's unexpected events. A strong financial foundation comprises 4 key components: saving, budgeting, investing, and protecting your assets. Saving is about setting aside a portion of your income for future use. Budgeting involves planning your spending to ensure you live within your means. Investing is the process of growing your wealth, while protecting your assets is about safeguarding what you've worked hard to accumulate. Together, these components create a robust structure for managing your finances. A strong financial foundation is the bedrock of financial security and freedom. Building a strong financial foundation begins with saving. Think of saving as the cornerstone of your financial house. Without it, the structure can easily crumble when faced with a financial emergency or unexpected expense. So, how do we start saving? The first step is setting a goal. Having a clear objective gives us a target to aim for and makes the process of saving feel more rewarding. This goal could be anything from buying a new car, saving up for a vacation, or simply having a safety net for rainy days. Once you have a goal, the next step is to create a savings plan. This involves determining how much you can afford to save each month. Remember, it's not about the size of the savings, but the consistency. Even if you can only put aside a small amount, doing so regularly can add up over time. Sticking to your savings plan is crucial. It can be tempting to dip into your savings for non-essential purchases, but remember your long-term goals and resist the urge. Finally, let's touch on emergency funds. These are a vital part of any financial plan. An emergency fund acts as a financial buffer, providing you with a safety net in case of unexpected expenses such as car repairs or medical bills. Remember, every penny saved is a step towards a stronger financial foundation. It's not just about having money in the bank, it's about building a secure and sustainable future. Once you've started saving, it's time to master budgeting. Picture budgeting as your personal financial compass, guiding you towards your money goals. It's a plan that helps you make the most of your income, ensuring you're not only covering your expenses, but also setting aside funds for the future. Let's break down how to create a budget. First, you'll want to identify your income. This is any money that you're earning, whether it's from a job, investments, or even a side hustle. Once you have a clear picture of your income, it's time to list out your expenses. This includes everything from your morning coffee to your rent or mortgage. Next, we move on to setting spending limits. This means allocating a specific amount of your income to different categories of spending. For example, you may decide that 50% of your income goes to needs like food and housing, 30% to wants like entertainment and eating out, and 20% to savings. Now, it's time to track your spending. It's crucial to know where your money is going, and if you're sticking to your budget. You can do this manually, or use one of the many budgeting apps available. Remember, your budget is not set in stone. It's a living document that you should revisit and adjust as your financial situation changes. With consistent tracking and adjusting, you'll see progress towards your financial goals. A well-planned budget is a roadmap to financial stability. With saving and budgeting in place, you're ready to step into the world of investing. Investing is about allocating resources, typically money, with the expectation of generating an income or profit. It's the key to growing your wealth over time and achieving your financial goals. At its core, investing involves purchasing assets that you believe will increase in value over time. These assets can take many forms, such as stocks, bonds, and mutual funds. Let's take a moment to unravel these terms. Stocks represent ownership in a company and a claim on a portion of that company's earnings and assets. As the company grows and becomes more profitable, so does the value of your stock. Bonds, on the other hand, are like loans you give to the government or a corporation. In return, they agree to pay you interest and to return the money on a specified date in the future. Mutual funds are a bit different. They are investment vehicles that pool together money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. This allows you to own a small portion of many different assets, and it's a great way to spread out your risk. Which brings us to two crucial principles of investing: diversification and understanding risk. Diversification, or not putting all your eggs in one basket, is a risk management strategy that combines a variety of investments within a portfolio. The rationale being that a diverse portfolio will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Understanding risk is also essential. All investments carry some level of risk. Generally, the higher the potential return, the higher the risk. Your job as an investor is to find the balance between risk and return that's right for you. Investing is the key to making your money work for you. It's not just about making more money, but about achieving financial independence, building your wealth, and getting closer to your financial goals. The final step in building a strong financial foundation is protecting your assets. Now you may wonder, how can you do that? One effective way is through insurance. Think of insurance as a safety vest you wear while navigating the unpredictable seas of life. Let's touch on a few types of insurance. Health insurance, for instance, can shield you from financial harm caused by unexpected medical expenses. Life insurance, on the other hand, provides a financial buffer for your loved ones in the event of your untimely demise. Property insurance, be it for your home or your car, protects against damages from accidents, theft, or natural disasters. These insurances serve as your financial safety net. They may seem like an extra expense, but in the long run they help safeguard your assets and your financial future. After all, it's better to be safe than sorry. Insurance is your financial safety net. So, are you ready to build your strong financial foundation? We've covered the key pillars that will get you there: the habit of saving, the discipline of budgeting, the power of investing, and the wisdom of protecting your assets. Each one is a stepping stone on the path to financial stability and success. Remember, a strong financial foundation is the first step towards financial freedom. The journey may seem long, but every step counts.